So I was just reminded today that you have that mini break. I mean, this would normally be your week, your spring break week, right? I mean, that's, so but you're getting a mini break, I think next Tuesday, Wednesday, Thursday, something. So we're missing, whatever it is, we're missing next week, next Wednesday's class. There is no class. So we'll be missing that class. So, just a reminder that that's the case. And if I don't remember to tell you again. Okay, we're at 9:30 or 12:30 your time, so 12:30 New York time. So I'm going to get started. Yeah. So before I get started, are there any questions? I mean, obviously I will not answer direct questions on the case, but as you can see, everything we're talking about has this subtext. And if you've read the case, you can read the subtext. So as we go through, if you want to ask a question that's really about your case, but you frame it in terms of what the material in the class is, I have no choice but to answer the question. Right? So I will leave that to you. So if you remember last session, we were talking about the Rio Disney theme park. And if you remember, I'd ground through the numbers. I did the revenues, the earnings. I came up with a return on invested capital, basically looking at after-tax operating income and the total capital invested in the project. And then I compared it to the cost of capital. And in spite of all of its limitations, it's used widely by companies. At least on that comparison, the project did not look good. Why? Because the average return on capital over the next 10 years is about 4.1%, and your cost of capital is 8.46%. And a reminder, the cost of capital for the Disney theme park reflects the business it's in, theme park business, and where I'm building the theme park, which is in Rio. So any questions up till there on the mechanics of what we've done? So towards the end of the class, then I said, if you buy into the return on capital as a measure of investment quality, then you can extend the question to extend the metric to answer a big question about companies, which is you look at your company as, are my company's existing projects good projects? One way to answer that question is to look at the return on invested capital for your whole company. So here's what you do. You take the operating income for your company. You act like you pay taxes on that operating income. So what you have in the numerator is after-tax operating income. So it's not your actual taxes paid. This is based on the tax rate on your overall income. And you divide it by the book value of invested capital. This is the only place, and let me re-emphasize that I've said that before, the only place in finance we use book values. So those of you who've been doing levered betas and cost of capital, if you've been doing book debt and book equity, go back and redo them. Those are all market value numbers. In fact, just as an aside, I've got at least a half a dozen emails from people frantically asking me whether they need to change companies. Because here's what they found. They found the book value of their equity in their company is negative. So let me ask you that question, because I actually answered this in my accounting mini class. Why does a company's book value of equity become negative? Mara, you want to try? What causes the book value of equity of a company to become negative?
I'm not sure.
So would it be if maybe I can help you. What goes into book value? What you originally raised in your IPO, but what causes it to change on a year-by-year basis?
New
which
earnings?
Is retained earnings, right? Basically, It's new earnings. So if you have a company that's losing money, what happens to your retained earnings? It's a negative number. So every year you lose money, I'm taking out of your book equity. If you keep losing money, eventually you can hit zero and keep going. So one of the reasons book value of equity can turn negative is you've had big losses. The other is, and this is a much more recent phenomenon, every time you buy back stock, what do? You go to the market, you buy back stock at the market price. Let's say a market price is 5 times or 10 times book value, which is not uncommon in this market. You buy even 10% of your shares, could very quickly happen to your book equity? It could become negative. In fact, if you have a company with negative book equity, and this is was my response to all 6 people who emailed me about this, is, hey, it's not that uncommon. 1 in 9 US companies, 1 in 9, that's almost 1,000 US companies now have negative book values of equity. And then I said, why do you care? What difference does it make? And they said, I'm trying to compute my debt to equity ratio. I can't use a negative number. I said, I agree. But the debt to equity ratio used for a levered beta or cost of capital is a market value number. The fact that the book value of equity is negative doesn't matter. So if any of you have negative book equity, look at it, let it go. Okay? It will show up when you do return on equity and return on capital. So you cannot compute the return on equity because you have negative book equity, but that's a side problem. It's a problem you can deal with differently. But return on invested capital is based on book value. And remember, the final point I made is once I compute that number for your company, Sean, for instance, this morning called me in office hours. He's way ahead of this project. So I'm going to shame all of you who are kind of lagging behind. He's actually computed the return on capital for his company, MTN. He's compared to the cost of capital. He's got the excess return nailed down. In fact, I think he's done the whole project already, and he's just coming to me in pieces. And Sean said, look, my return on capital is 2% higher than the cost of capital. This is MTN, South African telecom company. And I said, the next question you got to ask, and this is what I want you to think about in every part of your project. The mechanics of computing this 2% excess return. Fairly simple. There's nothing I've asked you to do that's sophisticated math, right? You're pulling numbers together, you come up with that 2%. What this project is all about is reading that number, that 2% excess return. Where is it coming from? What does MTN do that gives it barriers to entry? What are its competitive advantages? This is your chance to marry your numbers to the story you're telling about your company, because each of you on your company is telling me a story about the company. The story has good parts, it's got bad parts, there's some suspense. You don't know how it'll play out because it's still playing out. But what you're doing is fleshing out your story. So try to do this for your company as soon as you can, because this is, I think, you're going to get a little pause on your project after this section. So try to get caught up in this section and let that pause kind of help you get caught up in the rest of the class. But are there any questions on this number, return on capital, and what you're trying to measure with that number?
Professor, can you clarify why we use book value of capital?
Okay, because what's the question we're trying to answer? We're trying to answer, are your projects good projects, right? Let's say 2 years ago, you invested $100 million in a project and you're making a 30% return on that project. It's a really great project. If I estimate the market value of that project today, you know what I'm going to show, right? A much higher number, because if you're making a 30% return, people will pay much more than what you originally invested. So if I mark your businesses up to market value, then I'm not giving you credit for the fact that you invested only 100 million. You took really good projects. The market has now pushed up the price to reflect the fact that you took good projects. But I want to measure what you made on your original investment. So that's why we go back to book value. It's because we're trying to get a sense of what did you put into this business? What are you making on that? And is that a good enough return? Okay. So now let's, and if you look at the return on capital, it's got lots of flaws, right? It's based on accounting numbers. It's not time weighted. It's not incremental. So I'm going to take these accounting earnings you saw on the theme park and make them into numbers that are more useful. So here's the first step. I'm going to go from earnings to cash flows. Remember, it's a 3-step process. I keep it simple. Add back depreciation, amortization. That's the first item. Subtract out CapEx, and now you're seeing the big cash flows in the early years because you're investing to build the theme park, and subtract change in working capital. And reminder again, that just makes accrual earnings into cash earnings. You add depreciation, you subtract out CapEx, you subtract out change in working capital. Take a look at cash flows, very different from earnings, right? That's a point we made last class as well. Earnings and cash flows can be very different numbers, and especially in the first 4 years. It changes the way you think about this project because you're going to be spending tons of money over the next 4 years building the theme parks. But I want to focus in on those changes a little bit to get a sense of why we do what we do, because it's almost mechanical. Let's start with depreciation. We gave the rationale, right? You heard in every accounting class, in every finance class, depreciation is not a cash expense, it's an accounting expense. So we add it back. That seems a little odd that we're wasting our time, because here's why people say, why are we then wasting our time? Because here's what it looks like we're doing. We're subtracting it out to get to earnings, right? And then we're adding it back. Seems like It's not even a player in the game. So why bother? Why not just look at EBITDA and forget about depreciation altogether? You know why depreciation still leaves an imprint? I subtracted it out to get to earnings, and then I paid taxes based on those earnings. And if I have a lot of depreciation, guess what it does for me? It saves me taxes. In fact, I'll tell you exactly how much cash flows come just from my depreciation line item. If I take my depreciation each year, which I know because I've computed it, and multiply it by my marginal tax rate. In year one, I have 50 million depreciation. I get an $18 million tax benefit. That's just the tax rate times the depreciation. And you can see the higher my tax rate, the greater the benefit to depreciation. For the 1960s and 70s, one of the fastest growing businesses in the US was leasing. So here's how it worked. You're United Airlines, you want to buy an aircraft, rather than you buying the aircraft, here's what would happen. A group of very wealthy individuals would get together, get the capital together, buy the aircraft, and then lease it to United Airlines. You see, you're paying the same amount for the aircraft. Why would wealthy individuals buy aircraft and lease it to United Airlines? You know why they did this? In the 1970s, the highest individual marginal tax rate was 70%. The corporate tax rate was 40%. So what's the benefit of wealthy individuals getting together, gathering money and buying the aircraft? They get to depreciate the aircraft, right? And when they depreciate, what's the tax benefit they get? 70% of the depreciation. It's the exact same aircraft, exact same depreciation, but they get more tax benefits. You know what killed the leasing business, at least in part of that business, is in 1986. There was a brief period where tax laws in the US actually created rationality. What it meant was the highest individual and the marginal tax rates kind of converged. As the tax rates in individuals and companies converge, you've taken away a big reason for this business, right? Because you no longer get more tax benefits if you're a higher tax rate individual. So anytime tax rates start to diverge in an economy between different groups, you can almost predict that this kind of business will take over because people with higher taxes get more benefits. In fact, there are many universities actually lease a lot of stuff rather than buy their own stuff. You know why, right? What tax rate does a university pay? At least in theory, how does every university, at least pretty much every university other than University of Phoenix, how does it describe itself?
Nonprofit.
Nonprofit, which is a complete and total lie. It just means they collect profits other way, but it's a non-profit, which means they pay no taxes, which means if a university spends $100 million on equipment that's depreciable, what tax benefits does it get from it? Absolutely nothing. But if I am a taxable entity and I buy that same equipment, I get a depreciation tax benefit. So the effect of depreciation is a tax benefit. That's why we have to go through subtracting it out first and then adding it back in. And if you have non-cash charges that are not tax deductible, I'll give you a classic example. When goodwill, which is this fake item that accountants create when you do an acquisition, gets impaired, which is another fake thing that accountants do to tell you it's become less valuable. You know what all those fake transactions create? Nothing. Impairing goodwill creates no tax benefit. So why are we wasting our time doing this? I think you need to ask accountants. Every time I get asked a question about goodwill, I say I refuse to answer this question on the grounds that it's a complete waste of your time and my time, because it doesn't really matter. Do whatever you damn well want. This has nothing to do with doing the right thing. Now, companies don't have much discretion when it comes to how you depreciate an asset. But there was a time when companies could pick what depreciation method they could use. And broadly speaking, there are two ways you can depreciate an asset. One is called straight line depreciation. You know what I do in straight line depreciation? I take an item and I write it off in equal annual increments over 5 or 10 or 15 years. From an Excel spreadsheet standpoint, this is your dream approach because it made your life very simple. It's your chance now to thank me. You know why, right? In the case, what did I ask you to use? You don't even remember.
Straight line.
I said use straight line depreciation. I'm trying to help you out. I'm such a compassionate person. But there's an alternative, which is accelerated depreciation. There are a bunch of different depreciation methods that are accelerated, but here's the bottom line. In accelerated depreciation, you write off more upfront. You still write off the same amount, but you write more upfront and less later. So I have a very simple question. You have an asset, you've just invested in it. You have two choices. You can use straight line depreciation or accelerated depreciation. Which of these two approaches will give you higher net income next year? Lauren?
It'd be straight line because
And the reason is?
you're taking less depreciation
Less
this year, so you have
right?
higher, your costs are
higher
lower.
earnings.
Yeah.
So stay on. Which of these two approaches will give you a higher cash flow next year?
Would it be accelerated because you get a better tax benefit from it this year in cash, and so then you would get higher.
This is your classic conundrum, right? If you take the depreciation method that increases cash flows, which is what we say in finance we care about, you're going to take accelerated depreciation. But if you worry about earnings per share and net income, you're going to go with straight line. Is there a way you can eat your cake and have it too as a US company? Absolutely. You know, US companies are allowed to maintain two sets of books. And this is completely legal, a reporting book and a tax book. Which one do you see in your 10K? Those are your reporting books. And you can actually use different depreciation methods in each. So guess what many US companies do? They use straight line depreciation in reporting, but they use accelerated depreciation in their tax books. And that's why tax income and reported income for most US companies are not even close. Any questions? Now let's talk about capital expenditures. I mean, the rationale for subtracting capital expenditures is very straightforward. You buy land, you buy equipment, you buy machinery. I don't care what the accountant calls it, you still have to spend the money. You're saying, why would I do it? You either have to do it because you want to grow your business. If I want to make my investment bigger, in other words, I want to increase the capacity of my factory, I've got to invest more. But I also have to invest to maintain my existing assets. I gave you the example of the theme park that never replaces a ride. The rides will stop working and people will stop coming. So what do you have to do? You've got to put money back. And one way to think about how much money you need to put back, this maintenance capex, is to look at what you take out as depreciation. You don't have to put the whole thing back, but you say, look, this, and how much you put back will depend on how long a life you want your project to have. You want your project to have a long life. It's not some God-given assumption where you just say, I'll assume a longer life. You've got to act like you want your project to be around for a longer period and manage it very differently than if your project has a shorter life. So the reason I put capital expenditures in this theme park, and it increased over time, is I want this theme park to keep going after year 10 and not shut down in year 10. I'd have run it very differently if I wanted to shut it down in year 10, right? Because I would be investing in year 7, 8, 9, and 10. I'd just be letting things kind of ride. But here again, you sometimes have a choice. So let's say you run a software business. This is so old that the story, so I'll change the story because nobody does CDs anymore, right? So basically, let's suppose you're sorry, and you have $100 million expense now where you're going to give away promotional software. Basically, you're trying to get people to try your software, and you make it part of a package where people can buy your software for 1/10 of the cost. It's going to cost you $100 million. And your accountant tells you, you know what, you have a choice. You can either expense this $100 million right now, and the tax guys will let you do it, or you can capitalize it on the argument that the people who try the software will be around for, let's say your average customer stays on for 3 years. So here again, I'm going to ask you a question. Matthew Olstein, help me out here. Which of these two will give me the higher net income, expensing it or capitalizing it?
Expensing it will give you the, capitalizing it will give you the higher net income.
Capitalizing will give you the higher net income because you're writing it off over 3 years. But if I ask you which of these will give you the higher tax benefit, expensing will give you the higher tax benefit because you get the tax benefit right away. So companies which talk about customer acquisition costs being CapEx talk out of both sides of their mouth. And here's why. They want you to capitalize it in the reporting books. That's what they're backing. So when they do their adjusted EBITDA, they might add back the customer. But when they do their tax books, guess what they do? They take the entire customer acquisition cost, say this is all an expense from this year. Nobody stays on for more than 15 minutes, won't expense it. This dance between earnings and cash flows happens over and over again in choices that you don't even think about, in how you expense, whether you capitalize. Which brings me to my final adjustment, the working capital adjustment. And let me give you the intuition. The reason working capital ties up cash flows is the working capital we're talking about here is things like inventory. Think about running a small store. Some of you might actually come from families that run, small, their business is a small store. You know why if you run a small store and you turn around and look into your storeroom and it's filled to the top with inventory, you should cringe? Because while you have that inventory, while it sits on the shelves, it's making you no money. Absolutely none. It's a wasting asset. Let's suppose you're one of those store owners that gives credit to customers. Why? Because you want them to buy more stuff. But you do it saying, look, you can pay me in 2 or 4 weeks, but you don't charge them an interest. You might sell more, but you're tying up cash because until they pay you, that cash is tied up. So when we talk about working capital, we're talking about things like inventory and receivables. And here's how we try to minimize the working capital impact. Let's say your customers take 6 weeks to pay you. That ties up cash, right, for the next 6 weeks. One way you can make that effect smaller is if you can get your suppliers to give you 6 weeks to pay, right? Because then while you wait to get paid, you're not paying them either. That's called accounts payable. That's why we net out payables to come to working capital. So receivables and inventory tie up cash. Payables offset some of that effect. Working capital can drain cash flows, and in some businesses, it is often the biggest drain on cash flows. In retail, this used to be a huge drain on cash flows. And the key word is used to be, and you're going to see why. And part of it is I blame accounting for this. Accounting used to have this rule that to be a healthy company, your current ratio has to be 2. That's what I was taught. You know what a current ratio of 2 is? Your current assets have to be twice current liabilities. The stupidest and most non-data-based rule I can think of. Because basically, what does it lock every company into? A working capital drain, until Walmart came along and said, why 2? Why not 1? And they designed the business to do this, right? They were one of the first retailers to keep just-in-time inventory, where they said with computers, we can scan what's on the shelves, where we can keep track of our inventory. So basically, they reduced their inventory holdings. And they squeezed their suppliers like crazy. Often, many of their suppliers, Walmart is their biggest customer. So what does Walmart do? Say, well, you guys have to wait at least a month before we pay you. Now, you can threaten to leave, but what are you going to do? 80% of your revenues come from Walmart. Walmart, by doing that, reduced its working capital needs to about half of that of the sector. You know how much money it saved because of doing it? $3 billion in cash flows every year. This is not penny change. managing working capital is essentially a way in which you can keep this cash flow drain. And in fact, I remember about 15 years ago, I got a call in my office and they said, can you be a keynote speaker? And I said, at where? And they said, at a supply chain conference. And I said, what the heck is a supply chain? That's how ignorant I was. And they described it. I said, okay, you're managing working capital. Is that what you want me to come and talk about? How long am I going to say? You know, basically, you manage the supply chain better. What are you doing? You're reducing the working capital drain along the way. That's what good supply chain management is all about. So add back depreciation, subtract CapEx, subtract change in working capital. Any questions about those generic items and why they matter? So we've gone from earnings to cash flows. Let's go from cash flows to incremental cash flows. And I'm going to remind you of two items I gave you last session, but at the time said, why do I care? Remember I said Disney has already spent $500 million and it's not going to get it back if you don't take this project. I'm going to talk about how to deal with that. The accountant dealt with it as, you know, he didn't care. He just put it into the initial investment. He said, maybe we should do something differently. And the second thing I told you was about that allocated G&A. If you remember, I said 2/3 of that allocated G&A was going to be there anyway, whether you took this project or not. So I'm going to give you a little trick on incremental cash flows, and it works for me. Whenever you look at a line item in an expense or an income, here's the question I want you to ask. What will happen to this line item if I take this project? And then ask a second question. What will happen to this line item if I don't take this project? If your answer is the same, this is not an incremental item. Let's take the example of $500 million. You already spent it. What will happen if you take this project? You've already spent it, it's gone. What will happen if you don't take the project? You've already spent it, it's gone. This project is making no difference to it. Take the 2/3 of allocated G&A. If you take this project, what's going to happen? That 2/3 is just going to be put into this project. If you don't take this project, what will happen? That 2/3 is still going to be there. It's just going to go somewhere else in the company. It's still there. In fact, the first $500 million, and in fact, that's it. And we'll come back and talk about what I'm going to do. Here's what I'm going to do for each of these, and I'll come back and talk about both the sunk cost and allocated G&A. I'm going to take the $500 million in sunk cost out of my initial investment. Remember, I had $2.5 billion, but $500 million of that is going to be there anyway. Why am I counting it as if I'm going to be spending it? It's gone. So my initial investment is only the new $2 billion that I've got to invest. The $500 million is taken out of the picture. The other is on the allocated G&A, rather than keep the entire G&A, I'm going to keep only the 1/3 that is due to this project. I'm going to take back the other 2/3. And what it effectively means, I'm going to add back what I shouldn't have subtracted out. That's what this non-incremental allocated G&A line item is. It's I'm trying to fix my own mistake, saying, hey guys, I should never have taken this out. This is a non-incremental expense, so I'm going to add it back in to make my earnings higher. I'm focusing in on just a direct G&A caused by this project and the investment on this project. Now, the way I've done it is a little torturous, right? Because I subtracted out the allocated amount and then I'm cleaning up for the hey, I could have just done this directly. And if I did this directly, and somebody asked me about this, I think last class, why am I counting in sunk costs? Why am I taking in the entire, why not just take the direct G&A? I will get exactly the same cash flows. I just get it easier. So if you want to check your incremental cash flows, you can go the torturous route, do the entire income cleanup for your mistakes, or not make the mistakes in the first place and look at only the direct items. So my incremental cash flow focuses on only what is caused by this project. So let me take that $500 million that I've already spent. In finance, we call these sunk costs. And the rule in finance is very simple. Ignore sunk costs. But I'll make a confession. This is extraordinarily difficult for human beings to do. I'll give you an example. I don't know whether we stand in lines anymore, or whether you stand in lines in banks. But let's say you end up doing this really stupid thing of going to a bank or a government, let's make it the DMV. That's much more realistic, right? You go to the DMV, you're going to stand in a line. No matter where the DMV is in this country, it's almost like DMVs were never designed so you could go up to the counter right away. So you stand in a line. It's during a lunch break. And you ask the DMV security guy as if he knows the answer to this. Well, how long does it usually take? There are 6 people in line in front of me. How long do you think it'll take for me to get to the counter? Because I've got to get back, get back to my office. He says, about 5 minutes a person. He says, you know what? I have an hour. This will only take 30 minutes. So you stand in line. 30 minutes later, you're still standing in line. There are still 5 people in front of you. If you are thinking rationally, what should you do? You should say, that was really stupid. I wasted half an hour of my time. I should leave now. But then you know what you're going to say? I've already spent 30 minutes waiting in line. That's going to be wasted if I leave. You don't realize it's already wasted. What you do now has no effect on it. But our life is full of decisions we've made that weigh us down because we think that by doing something now we can make it back. If your nerves are a little raw, don't do this week's weekly challenge. Because you know what I make you do? I make you rethink this entire decision you made to come to business school. You've already made the decision, right? It's a sunk cost. But let's say it's the end of the first year and you look back and say, this was the biggest waste of time. This is really going to do nothing for the rest of my life. And I give you the numbers from this point on and say, well, what should your decision be? It's impossible not to factor that you've already spent a year of your life in this endeavor. What I'm trying to say is we know what the rule is, but we also know that human beings factor in what's already happened. In fact, there is this famous experiment that was run on I think it was on an aircraft, it might have been Boeing, where they took 2 groups of managers and they put them in different rooms and they presented them with a case about a supersonic jet that the company was working on and had been working on for years. So the first group, the group was told, look, we've been spending the last 7 years working on this jet. We've spent $5 billion already. And it looks like a competitor has come up with a much better jet. So if we decide to go forward, it's going to cost us, another $2 billion, and we're not going to make enough money to cover. And people are asked to make a decision. Should we continue with this given that the competitors come up with a better business? But they've been told we've already spent 6 years and $5 billion. That group, almost everybody said we should keep going with this jet, even though it doesn't make sense anymore, even though it's no longer, we've already spent so much money. And the second group was given the same facts, but they forgot to mention one thing, how much time and money they'd already spent. And given the same facts, they said, let's cut this project now. That's a sunk cost effect. The more you know about how much money and time you've spent on something, the more difficult it becomes to ignore that in your decision making. So I'm not saying do something differently, but I'm saying it's natural to find yourself thinking about sunk costs. So I'm asking you to do something unnatural. Ignore those sunk costs. It's already happened. Nothing you do now will bring it back. Which raises an interesting challenge, especially for companies that do R&D. And there's a long lead time between doing R&D and a commercial product emerges. Or a consumer product company that does test marketing. Remember, the way this works usually is you spend the money on R&D, you spend the money on test marketing, and then you get to a point where you ask, what should we do now? So let's say you have a company. It spent $100 million on test marketing. And now you come to the decision point, and based purely on future cash flows, I'm following the corporate finance textbook rule and saying, based on the future cash flows, this this project will add about 25 million value just based on the future cash flows. The rule in sunk costs is take the project. It's going to add 25 million. But think about the net effect of this project on your overall company. You spent 100 million already. Now you created a project that adds 25 million. Net this project destroyed 75 million. If every single one of your projects looks like this one, you're going to be bankrupt sooner rather than later. And that raises a really interesting question for companies that do a lot of R&D and test marketing. If you wait to make your decision after the R&D and the test marketing, which seems to be the sensible thing, let's get the information, you've already lost the battle because the money has already been spent. So you need almost a two-level analysis, right? Which is before you do the test marketing, the R&D, somebody's got to make an assessment. Does this business even make sense? Should we be even doing R&D and test marketing? It will be based on very fuzzy information if you don't know much. But if you don't do that, it's always going to happen first, and you're going to be given a fait accompli, which is that you've got to take the project. Pharmaceutical companies learned this the hard way. The 1980s, here's how pharmaceutical companies used to work. They used to spend money on R&D. They just write the check out. How much do you need for R&D? 15 billion. Okay, there, have it. And here's what they would do. They would come up with a product. And then because they had so much pricing power, they would take the R&D cost, put it into the price of the product, pass it through and make a healthy margin. And then the business changed under them. They started negotiating with fewer and fewer players because the other side of the table got concentrated. Instead of negotiating with 1,000 insurance companies, they started negotiating with 5 big insurance companies and the giant in the room, Medicare. And they found their pricing power was getting squeezed. So they were actually spending billions of dollars coming up with the product and then finding that they were making much less. So they actually had to force the R&D process, even though the R&D guys hated this, into creating a front level justification of why do you want us to spend $5 billion on a better whatever medication, better arthritis medication. And you'd have to make that judgment based on the size of the market and the medicines that are already out there that this drug actually made sense. Any questions on sunk costs? Which brings me to that allocated cost. And I told you where this comes from. It comes from the fact they have all these expenses without revenues. The accountant hates it. So what does he do? He gathers these expenses together and starts allocating them. But it's an accounting fiction. It is not incremental. And I'll give you a very simple anecdote to illustrate this process of incremental. So about 20 years ago, I used to spend my summers doing training programs for the investment banks because I don't consult, but I, basically a week. And so basically it'd be 3 or 4 days of corporate finance and Goldman Sachs, JP Morgan, et cetera, back to back to back. And my entire middle of July, the middle of August, I didn't even know which investment bank I was in because I was doing the same thing. And after a while, it could have been any of them. And these were the days, I think it was late 90s when investment banks were doing really well and the training programs were really well fed and their ice cream for break and all kinds. You can always tell how an investment bank is doing based on how they treat their training. So this was, I think, and the training groups were huge. So we actually had to, I actually had to teach these classes in ballrooms in hotels because no training class would fit them. So I don't know which hotel it was in Midtown. I was doing this group for about 350, newly hired, and usually it's analysts, not associates, so newly hired analysts. And it was a 3-day corporate finance class, and we're talking about it's not even a compressed version. It was this entire class filled into 3 days, and I was getting to the end of my tether. I'd been teaching for 27 days. I had no idea what was coming and going. I was an autopilot. You could have turned me on at 8:30 in the morning. I could have taught the whole class without even thinking about what I was doing. And the group was also just as jaded. They were ready to get on the desk. They were bored. So basically, neither me nor the group was really that involved. But there was one person who was very interested. It was this guy who was doing the catering, setting it up on the outside. He stood at the door of the ballroom listening to every single word. He was the most attentive person by far in the entire room. So after I finished the section, he comes to me and he says, look, I have a question to ask you. And I said, thank God somebody has a question. And he said, I am from Honduras, and every year when I fly back to Honduras, I buy seconds at the Gap and the Limit. You know what seconds are? These are clothes with small defects in them. You can get them at a discount. So I buy bunches of clothes at the Gap and Limited. I fly back to Honduras and I sell them for a higher price, and I make about $400. But it cost me about $700 to fly round trip, and my accountant friends tell me that I should stop doing this. So my first advice to him is stop having accountant friends. And he said, you see how the accounting mind works, right? You make 400, it costs you 750, it's a minus 350, it's a bad business. So I asked him the question. You know what the question I asked him was? Dan, what do you think I asked him?
I don't know, depreciation maybe? Do you get to?
No, I said, would you fly back to Honduras anyway?
Yeah, you're gonna, yeah.
And he said, my entire
Sum up.
family's back there. I'm going to fly back to Honduras anyway. So you know what that makes the $750? He's going to spend it anyway. Right now, at least, what's he doing? He's netting the cost and making it lower. And if he listens to his accountant friends and stops buying the seconds, guess what he's going to do next year? He's going to fly to Honduras. He's going to spend $750, and he's not even going to get the $400 offset he did the previous year. That's why we want to focus on incremental. If you focus on accounting bottom lines, reflecting allocated costs, you could be shutting businesses down that look bad, but then after you shut them down, guess what? The costs just pop up somewhere else. I remember in the late 90s, one of the investment banks, I don't even know which one, shut down its Asian equities. At that time, its Asian equities division was actually run out of New York. But they shut it down because Asia was going through a crisis, and they said Asian equities has no future. In hindsight, you can see how crazy that was. And I asked them, why did you shut down Asian equities? And they said Asian equities is a money loser. You know why it was a money loser? Because they were allocating everything but the kids. Everything Asia related was being allocated to Asian equities. You ordered Chinese food. It got allocated to Asian equities. Why? It's Chinese, it's Asian, but it's put in Asian equities. You shut down Asian equities. Do you think people are going to stop ordering Chinese food? Of course they're going to continue ordering Chinese food. That's why we focus on, and the question then is, how do I know what's because in a sense, what I'm asking you to do, look at G&A and tell me what's fixed, what's variable, what's driven by it. It's tough to do, but I'll give you a way in which you might be able to do it. And I'll use a very simplistic example to illustrate it. Let's suppose you're looking at a company, you have 3 years of history. So let's say it's 2017, 2018, 2019. Let's forget about 2020. I give you the revenues each year, billion, 1.2 billion, 1.5 billion. I give you the G&A costs, the total G&A costs each year. So Shreya, I want you to help me out here. Given those numbers, can you give me a sense of what percentage of this year's G&A costs? So I have 300 million G&A costs. What percentage of that cost is variable?
Yeah, 1 minute. So I take the difference in the G&A costs between the first and second year.
Which would be
So
20 million.
yeah, and the difference in revenues.
Which is
And
200 million. So that 10, so it
about
looks like,
10%.
So in year 3, for instance, when I have 1,500 million in revenues, 10% of 1,500 million will give me 150 million. That's my variable cost, which means my remaining 150 million is a fixed cost. I know it's very simplistic because G&A is all kinds of things making it move around. But if you give me a pattern of revenues for your company and a pattern of G&A, I can at least start to tell you how much of this is fixed and how much is variable. It's a very useful tactic. Because especially when you see young companies going public, you get these expense line items. And if you look at them as a percentage of revenues, you can start to get a sense of which of these costs are direct costs tied to the revenues and which of these costs are more likely to deliver economies of scale. Because economies of scale require that some of the costs be fixed. So it's, as I said, so try this on your company. I'm not saying you're going to get anything miraculous, but take, you have enough history on your company, you can go back and look over its revenues and G&A. And at least to draw some conclusions. So let's see where we are. We moved from accounting earnings to cash flows, from cash flows to incremental cash flows. Let's take the final step. I want to time weight these cash flows. That sounds fancy. But you know what discounting does? This is no longer part of every corporate finance textbook, but it used to be that every finance textbook, at the end of the book, you'd have what were called present value tables. Have you ever seen these? You'd have to get an ancient version of the book to do it. But in a present value table, here's what you'll be told. This is how much $1 in cash flows will be worth if you get in year 1, year 2, year 3. And it'll give you a set of discount rates at the top. So with a 10% discount rate, $1 in cash flows today is worth 91 cents in a year, 82. So basically you'll see that. So that's your time waiting, right? Because if you have a high discount rate and you have to wait a long time, $1 in cash flows is worth only 31 cents. So what I'm trying to say in a long-winded way is, if you can discount these incremental cash flows, you've essentially time weighted the cash flows. And what do you need to discount these cash flows? You need a discount rate. Now do you see why I sequenced this class the way I did? We spent our time coming up with discount rates first before we approached investment analysis. Why? Because without a discount rate, I'm going to get to this point and say, guys, I don't know what to do now. So to time weight these cash flows, you're just taking present value. If this page intimidates you, just act like you never saw it. This is a throwback table. You know how on your calculator, when I ask you for a present value of an annuity, you know what you do, or even on a computer, you enter the payment, you enter N, you enter R, you hit the PV button. Magic happens, right? And not really, there's an equation embedded in the calculator that calculates the present value of an annuity. This is that equation. If you don't believe me, try it out. It'll give you immense power, because you know what? Because from this day on, you don't need a financial calculator. You don't need a PV button. You just need a calculator a scientific calculator. $7 calculator will basically do this for you. So in this page, I have every conceivable type of cash flow you can run into in finance. Let's start with the simple cash flow. It's a simple cash flow. I tell you, look, you can make 15 million 10 years from now. What's it worth today? That's a simple cash flow. I just take the 15 million, discount it back to today. In an annuity, I give you a constant cash flow at regular intervals going into the future. 4 million a year every year for the next 10 years. How much is it worth? The present value of an annuity. A growing annuity is actually something you don't see built into the calculator, but it's a very useful equation to have. What's a growing annuity? You own a gold mine. It produces $1 million in cash flows this year, but I expect those cash flows to grow at 3% a year for the next 25 years, and then the gold runs out. And ask you, what's the present value of those cash flows? You can do it the long way, right? Which is take the cash flow in year 1, year 2, year 3, discount each cash. That'll always work. But that's 25 cash flows to discount. This is the present value of a growing annuity. If you don't believe me again, take $1 million for 25 years, do it the long way, then use the cash. It'll give you the capacity to come up with a quick present value. And it's not an approximation, it's the actual answer of a growing annuity. And then you get to two types of cash flows that are kind of mind-boggling. The first is a cash flow that's a constant cash flow forever. It's a perpetuity. You know why it's mind-boggling? Because forever is a mind-boggling concept. None of it's going to be around. This cash flow keeps going and going and going and going and going forever. In the 1600s and 1700s, maybe even into the 1800s, the British government used to issue console bonds. Basically, this was a bond without a maturity, but you'd get a coupon every year forever. I think in the last 100 years, the Canadian government issued some console bonds as well. The US government has never issued a console bond, but it could if it wanted to. It's a perpetuity, constant coupon. But if a notion of getting a cash flow forever is mind-boggling, here's an even more mind-boggling concept. A cash flow that only lasts forever, but grows every year forever. This, of course, is a growing perpetuity, the most used and misused equation in all of finance. Misused because if you mess with that equation, terrible things are going to happen. Because what's in the denominator? R minus G. About 4 weeks ago, I got this email from the guy claims to be a professor of finance. I won't name the country. I think he's a professor of finance somewhere in Bangladesh. He keeps emailing me every week claiming that everything in finance is wrong and that he's patented some new way of valuing companies. And he's fixated on this equation. He said, look, this equation is wrong. I tried it on a company in Bangladesh and I keep getting negative values, even though it's a money-making company. You know why he was getting negative values? He was using a growth rate of 12% a year and a discount rate of 10. And you're saying, yeah, things are not working. You can say, when G exceeds R, this equation is going to break down. And God help you, G is equal to R, because you know what's going to happen then? You're going to infinity and beyond. If that sounds familiar, you're Buzz Lightyear. There you go. Infinity and beyond. Just put G equal to R. If you're going to use a growing perpetuity, remember it's forever. And if it's forever, that growth rate cannot be greater than the growth rate of the economy forever. For those of you in my valuation class now, I make a big deal of this. In this class, I'll come back and make a big deal when we get to valuation. But everywhere we use this equation, that growth rate comes with a constraint. It's going to be a really low number, especially in today's world where inflation is low and real growth is low. So here are the two ways in which I can compute time-weighted returns. I can take each of your incremental cash flows, discount them back to the present, add up those present values and come up with a net present value. And if you have a net present value for a project, the rule is very simple. If it's greater than zero, even with just $1, you take the project. You know how tough a concept that is to get through to managers? You take a $10 billion project and you deliver a net present value of $1. What's your reaction? That's not enough. I spent $10 billion. You give me just $1 back. Why is it still a good project, even if your net present value is only $1? Michael, what is it about net present value that makes it still?
As long as it's more than zero, you're earning more than your hurdle rate.
Yeah, I'm not saying you're not making $1. I'm saying you're making whatever you need to make on this project plus $1. Would I rather make $1 billion? Yes. But beggars can't be choosers. Remember I showed you what 2/3 of companies globally do? They have a tough time earning their cost of capital. You're earning your cost of capital plus $1, don't look a gift horse in the mouth. This is still a good project. That's NPV. It's a dollar-based measure of time-weighted returns. And a lot of people don't like dollar-weighted measures. And I'll tell you why. If I ask Nate what his portfolio did last year, Nate, what did your portfolio do last year? You can give me, you can make up a number if you want to make it look better.
Fabulously.
And if I ask you for a number, how do you usually specify how your portfolio did?
I'd give you a percent.
Right? You say my portfolio made 31%. Nobody says my portfolio did went up by $310,000 or 31,000 or 3,000 because nobody can frame it. So we think in percentage terms, and the NPV gives you a dollar value. So there is a time-weighted incremental cash flow approach that's in percent terms, and here's how I get it. I take the cash flows you gave me, I take your initial investment, and I try different discount rates. And what am I looking for? I'm looking for that discount rate that makes my net present value zero. And once I find it, that's called the internal rate of return. And once I get that internal rate of return, you know what I do? I compare it to my cost of capital or cost of equity. I still bring in the hurdle rate, but it comes in after I've done the calculation. NPV and IRR are both time-weighted measures. Most of the time, they will lead you to the same place. Sometimes they will diverge, and we'll talk about why, but they're both time-weighted cash flow returns. So with that set up, I'm going to go back to the project. Remember when we did return on capital? My concern with return on capital is I stopped after year 10, but this project would keep going and going, and I wasn't factoring that in. And at that time, I just threw up my hands and said, nothing I can do. But now there's something I can do with incremental cash flows. I still don't want to do incremental cash flows in year 11, 12, because it's going to be tiresome, it's going to be difficult. I'm going to stop in year 10, but I'm going to stop and make an assumption. And here's what I'm going to assume. I'm going to assume that Disney will continue to operate the theme park beyond year 10. And it'll increase prices. It won't increase capacity. The number of people coming to the theme park will level off in year 10. So I don't have to build fresh rides and make it bigger, but I will increase prices at the inflation rate. Is that realistic? Hey, I've been going to Disney with my kids since 1991. Pretty much every year, sometimes 2 or 3 times a year. Hey, I can tell you from experience, they can raise the prices at above the inflation rate. I'm so probably being a little conservative saying the inflation rate at the inflation rate. See what I've created? And I assume that this will continue forever. I know part of you saying, no, nothing lasts forever. I'll come back and explain why I used a perpetuity, but I'm going to assume your cash flows will continue beyond year 10, forever growing at the inflation rate. So what type of cash flow is it? It's a growing perpetuity, right? The inflation rate was 2% in 2013. My cash flow in year 10 was 715 million. And one of the simple rules on these growing perpetuity equations is you always need the cash flow 1 year out. So to get the value in year 10, the value, the terminal value as it's called in year 10, I need cash flows in year 11. So I take cash flows in year 10, grow them at the inflation rate, that gives me cash flows in year 11, divided by R. Does the 8.46% look even remotely familiar? That was the cost of capital we computed for this theme park based on the fact that it was in Rio. Minus the 2% gives me 11,275 million. I've created an elephant in the room, right? Because when I put that cash flow in, I mean, it jumps out at you. Look at all those cash flows for the next 10 years and look at that cash flow at the end of year 10. So I'm going to ask you a question. This is a question that I don't think we think about enough. What exactly is that gigantic number in year 10? What does that represent? What does it capture? Brian, if I ask you for an intuitive explanation of the terminal value, what is the best hook to hang it on?
If you live forever, that's how much the company's worth today.
Okay, that already puts us in order. None of us is going to live forever, right? So in a sense, why do you have to live forever? The project lives forever, right? I mean, you and I don't have to live forever. The people buying it can pass it on to the next generation. So let's reframe it. The project lasts forever, and my assumptions are right. This is how much I would pay for Rio Disney at the end of year 10 if I was able to buy it lock, stock, barrel, and Mickey included. Now, this is what somebody would pay for this theme park based on its cash flows. You can already see there is zero chance that Disney will ever sell the theme park. You know why? Because Mickey's got to go with the theme park. This is Disney. They can't get, they can't say, hey, you can have Mickey for just the theme park. So this is a hypothetical. If Disney sold this theme park, lock, stock, barrel, everything included with the cash flows. So it's not based on what you've invested in, the fact that there's physical infrastructure. It's based on cash flows continuing. And does it make a difference? Boy, does it make a difference, because once I bring in the terminal value and discount all my cash flows, including the terminal value back at that 8.46% cost of capital, I get a $3.3 billion net present value. Remember, the project did not look good with the accounting return on capital, and I stopped it in year 10. Now that I've brought in what happens after year 10, the project has flipped from being a bad project to a good project. Right? So I actually presented this to a group of people in the theme park business. And you know what the first pushback was, right? They said, you're assuming this theme park lasts forever. Theme parks have long lives, but theme parks don't last forever. Tastes change. And they said, why are you assuming forever? So I said, okay, tell me how long do you think a theme park will last? They said 50 years. So you know what I did? At the end of year 10, instead of assuming the cash flows would continue forever, I assumed they would continue for another 40 years. Remember, it's a growing annuity. Remember, we have that equation. I computed what the value, the terminal value would be if I had 40 years instead of forever. You know what this number looked like? So being 11.275 billion was about 11 billion. It made almost no difference. when people use perpetuity assumptions, the constant pushback is nothing lasts forever. You don't have need for something to last forever. If it lasts a long enough time, you can use the perpetuity. If this were a 20-year project, I'd be on dangerous ground, assuming after year 10 forever. But with a 50-year, 75, any infrastructure project, you're going to be on perfectly solid ground using the perpetuity assumption. So this project, based on its net present value, is a good project. Remember, you're the decision maker. I did the number crunching. You get ready to say yes, and then you think about the fact that you got to present this to the board of directors who don't know anything about cash flows and discount rates, and you can't just go and say, we're taking this project with an NPV. So I want to ask you a question about NPV, which is again a question I don't think we ask often enough. What does that 3.3 billion tell you about this? What is going to happen to Disney as a company if they take this project? The nice thing about NPV is it actually measures your change in value from taking a project. In other words, if Disney takes this project, their value as a company will increase by 3.3 billion. So let's play a little game. If this project had a net present value of just $1 billion, taking that project would add $1 billion to your value. If this project has an NPV of 0, how much will Disney's value change? Absolutely nothing. And this is a project where you're making yourself big. You're saying how your revenues will grow, your numbers will all look bigger, but your value will not change. And what if this project had a minus in front of the 3.3 billion? What if this was a minus $3.3 billion project? The minute you take this project, what's going to happen? Daniel? If it's a negative net present value project, what's going to happen to the project?
And I reduce the value.
It'll reduce your value by 3.3 billion, right? You're saying who'd be stupid enough to take a minus $3.3 billion project? Every year, there are dozens of companies that take investments with net present values that are minus multiple billions. And they're aided and abetted by an ecosystem that tells them that this is the right thing to do. It's my cynical side kicking in. You know what kind of investments bring minus 3, minus 5, minus 10, minus $15 billion NPVs, right? Jeremy, what kinds of investments have the capacity to deliver that kind of negative net present value? He doesn't have.
My wife is tutoring in the same room. So
Oh, sorry. Okay.
You weren't going to call on me. No,
I'm sorry about that. I'll let you go. Okay, so, Bucky, what kind of investments would bring that kind of negative NPV? What does a company have to do to have?
I mean, I don't think any company would take that project, so I don't think there would be any projects with that.
Really, I'll tell you, there are at least 100 companies among big US companies. I would say at least 100 companies every year I see which take negative net present value projects, minus 5, minus 10. Ryan?
Airline development or aircraft development.
That could be a big infrastructure, but that's at least a long drawn out pain. And you could give me some rationale about how you didn't forecast COVID coming and demand for airlines dropping. So it could be a very big, but it's got to be huge, right? Because it's the net present value that's negative, 5 billion. So it'll have to be a 30 billion, 40 billion, $50 billion project to deliver. Cody?
An acquisition?
That's it. You do a big acquisition and you overpay. You know, you can frame it however. You can tell me there's strategic consideration, there's synergy. Doesn't matter if all of it is brought in and you paid $5 billion too much. You just took a negative net. And you know what happens, right? On the day of you announce the acquisition, take a look at the acquiring company's market value. You'd be shocked at how much acquiring companies can lose on that one day. Remember I showed you the Eastman Kodak example? That gets played out time after time after time. So any questions on NPV? Let's talk about IRR. If I asked you, how do you get IRR? You're going to give me this puzzled look, right? Because what's the answer? I hit the IRR button on my calculator. I use the IRR function in Excel. True. But here's a more interesting way of thinking about IRR. What did I say IRR was? It's that discount rate that makes your net present value zero, right? So I took my project, this Disney theme park, and I tried different discount rates, 0, 1, 2. And as my discount rates went up, my net present value went down. What am I looking for? I'm looking for the point at which this line crosses the axis. That is my internal rate of return, which in the case of Disney, the Rio Disney theme park is 12.6%. I'd have got roughly about the same answer if I use the IRR function in Excel. But here's what I wouldn't have if I use the IRR function in Excel. I wouldn't have this graph. You see, so what does this graph tell me? What is the slope of this line tell me? Anybody? Mekala? What does the slope of that line tell me?
Sorry, I'm not sure.
Discount rate?
It tells me how sensitive my net present value is to changes in my discount rate, right? Do you guys remember bond duration from your foundations class? What does bond duration tell you? How sensitive your bond price is to changes in interest rates. So this is a rough measure of how sensitive my net present value is to my being wrong in the discount rate. Could I be wrong in the discount rate? Of course, right? Because I made them on estimates of betas, risk premiums, risk-free rates. So let's say you have two projects with roughly the same IRR, but one project has a much steeper line than the other. In other words, they both crossed at 12.6%, but one was a much steeper line. Dwanish, which project would I pick? The one with the steeper line or the one with the flatter line?
The flatter line?
Because it's less sensitive. So it's a secondary measure of risk because you can ask, and that's the advantage of doing it with the visual is you can see it play out. And guess what? The IRR gives me the same decision as the NPV. 12.6% is higher than my 8.46%. And most of the time, IRR and NPV will lead you to the same place. They're both time-weighted incremental cash flows. Later in this class, in a session or two, I'm going to focus on when they can give you different answers. Okay? And I'll summarize the key differences. One is a project can have only one NPV. It's unique. A project can have more than one IRR. I'll leave you thinking about how you can have more than one IRR, but it's a mathematical reality. You can have more than one IRR. NPV is a dollar value. IRR is a percentage value, which already means that IRR is going to be tilted towards smaller projects. It's more biased. Why? Because it's easier to make a bigger percentage return if you invest $1 billion rather than 10 billion. Finally, NPV and IRR make different assumptions about reinvestment. I'll come back and talk more specifically. It's not a huge deal breaker, but they make different assumptions. What happens to cash flows you get in year 1, year 2, year 3, and that can play out in how you rank projects. So we're almost to the end of the Disney theme park. It looks like a good project, both on an NPV and IRR basis. Not that good an accounting return, but I kind of explained the difference because of what happens after year 10. Now, I also told you when I put these numbers up that I was cheating. Right? Remember what I meant by cheating? That I was going to use dollars when in fact the cash flows would be in reais. So I'm going to ask you a kind of general question. If I had taken the same project that I just showed you and done everything in Brazilian reais, remember the project looked good on a dollar basis? Would my answer be different if I had done everything in reais? Kushal, what do you think?
Not if the discount rate is adjusted too.
Okay, so, and more generically, you don't want it to give different answers, right? Can you imagine going to your CFO and saying, look, I've done the project and it has 3 currencies. It looks good in dollars. It looks terrible. It's either a good project or a bad project. So let's play through. Kushal, you stay on. If I convert this entire analysis to do it in reais, what's going to happen to my discount rate? My discount rate in dollars was 8.46%. If I did the whole thing in reais, what's going to happen to my discount rate?
It'll increase.
It'll increase. Why? Because it's a higher inflation currency. So I have higher discount rates, right? You're saying, what else will change? My cash flows now have to be in reais as well, which means I've got to take my dollar cash flows and convert them into real cash flows. And to do that, I need expected exchange rates. Now, I told you that discount rates will be higher in REI because the inflation in REI is higher than the inflation rate in dollars. Does that inflation difference also play out in exchange rates? If the inflation rate in reais is higher than the inflation rate in dollars, Mallory, what's going to happen to the exchange rate between the dollar and the real if the real has much higher inflation than the dollar? I don't think, I can't hear you, so I don't know whether your mic's working. So.
Can you hear me now?
Yep.
As in, like, what's going to happen with the price in real or dollar?
Because exchange rates change over time. Will the real depreciate against the dollar or appreciate if it has higher inflation?
Wait, sorry, would you? I don't understand.
Okay. The real has 9% inflation. The dollar is 2% inflation. I'm tracking the exchange rate over time of how many reais I will get per dollar.
Right.
If the inflation rate in real is higher than the inflation rate in dollars, will I get more reais per dollar next year or less reais per dollar next year?
More reais.
More reais. So when you have higher inflation, you see the currency depreciate. In fact, in exchange rates, there's this very simple theorem that ties inflation to exchange rates. It's called purchasing power parity. It's fancy, but if your inflation rate is 7% higher than mine, your currency will depreciate about 7% a year. In fact, the economists used to have an index called the Big Mac Index. I don't know whether they still show it, but they'd show you the price of a Big Mac in different parts of the world converted into one currency. It's purchasing power parity play out. So here's what I'm going to do. I'm going to first adjust the discount rate to reais, and that's fairly easy because we've done this before. To take my dollar cost of capital, 8.46%, and convert to real cost of capital, I bring in that 7% difference in inflation rate. So my real discount rate is 15.91%, and that was Kushal's instinct, and it turns out to be true. Much higher discount rates because I'm discounting in a higher inflation currency. And for the exchange rate, I use the same process. I take the exchange rate today and I adjust for the fact that the inflation is higher in reais than dollars. So guess what's going to happen to the exchange rate? You're going to get more reais per dollar every year as you go through time because the inflation is higher. So let's bring them both into effect. First, my discount rate is 15.91%, higher discount rate. Take a look at how many reais I get per dollar. And Mallory's instincts are right. Because the inflation is higher, the real exchange rate goes from 2.35 to 4.56 reais per dollar. This is as old as time, right? When you have different inflations in different currencies, it shows up. Now, will it happen every year in the pattern? No, because strange things can happen to exchange rates in any given year. I remember I presented this in Brazil in 2014 when the real was at 2.35, and it had actually strengthened over the previous 3 years, even though inflation was higher. You know what I heard, right? Oh, the rules have changed, inflation doesn't matter anymore, the real is now on a strengthening phase. And guess what happened over the next 3 years? The real went to 4 reais per dollar. This, you can play games on individual years, but over time this will kick in. So if you look at the numbers, basically, there are my real numbers. There's my real exchange rate. I discount the real cash flows at the real discount rate. What I get as a net present value is 7,745 million reais. Hang in there. If I convert that net present value into US dollars using today's exchange rate, I get 3,296 million. That sounds familiar. That is actually the exact same NPV I got using dollar values. This is incredibly good news, folks. You know why? Because when I ask you to do a project analysis, here's all you need to do. Pick one currency and stay consistent with that currency. Don't go back and forth. That'll get you into trouble. People mess this up in every conceivable way you can think of. I'll give you one typical mess up. People will compute a real cost of capital, but to get future cash flows, here's what they do. They take the expected cash flows in dollars. Instead of using the expected exchange rate, they just use today's exchange rate. I'll tell you exactly what's going to happen if you do that. Your real net present values is going to be vastly lower than the net present value you're going to have in dollars. And here's why. You're building in a dollar inflation rate into your cash flows and punishing those cash flows with a real inflation rate-based discount rate. It's about consistency in inflation, and that's why we care about currencies. So any questions on that dimension? Okay. So
I have a question.
Now go ahead.
Is it only inflation that has an effect on future exchange rates?
Tell me what else can. In any given year, you can have all
Demand
kinds of things,
for
right? Central banking intervention, you can have, so in any given year, that's why I said in an individual year, exchange rates can do other things. But in the long term, inflation is by far, it might not be 100%, but it is the dominant variable driving differences in exchange rates.
Thank you.
Which brings me to the final thing I want to say about this project. If you think about it, I made a lot of assumptions to get to these cash flows, right? About revenues, about costs, about tax rates, about interest rates, about risk premiums, about betas. Could I be wrong on any or all of them? Absolutely. Every single one of these numbers is an assumption, right? Uncertainty is a feature, not a bug, of investment analysis. So I'm going to ask you a question because this is something you will run into in business, even if you're not in finance. You sit down to analyze a project, a decision, you face a lot of uncertainty. So here are your choices. You can wait for the uncertainty to resolve itself. So if you did that, how long are you going to wait? Forever. You say, let's wait for COVID to pass, okay? Once COVID passes, you think you're going to be in this dreamland where nothing bad happens to you? The 2008 crisis passed, we said, oh, thank God that passed. Then Greece hit, then Ukraine hit, then, you're going to have other uncertainties that pop up. Maybe you're the kind of person who says, I will not take an investment if there's uncertainty. Then you're going to run a money market fund, basically. Basically, no company can exist. This is an excellent choice. If you're a CFO or a CEO or a manager, you know what you should do? Call in McKinsey. Ask them what to do. Pay them a lot of money. And then if something goes wrong, what can you do? You can lay McKinsey. They just told me to do this. Why do you think consultants are so widely sought? It's not because they give great advice. It allows you to pass the buck. Maybe you're just completely unfazed by uncertainty. You're a riverboat gambler. The only problem is I don't want you running my company. Let's face it, we're all made uncomfortable by uncertainty. We tried to make it go away. We tried to deal with it. So I'm going to give you 3 ways in which you could deal with uncertainty. Here's the oldest. It's one of the oldest techniques for dealing with it. What are you so worried about in this project? You're investing $5 billion and you're worried you will not just have a bad project, but you could lose a big chunk of that money. So would it help you if I told you how many years it'll take you to get the $5 billion back? It's called payback. It's a very simplistic way of saying, hey, look, you can get the $5 billion back in 5 years. And the less time it takes, the more comfortable you feel. And then everything else is icing on the cake. This project, the payback is about 10 years. It takes about 10 years. So basically, I just add up the cash flows to see when my total cash flows turn positive. If you want to bring in the time value of money, it takes about 17 years. You're saying, what do I do with that? There are companies out there that have rigid rules on payback. They will not take a project where the payback is more than 3 years or 5 years. It sounds simplistic, but it's a way in which they deal with the fact that there's a lot of uncertainty in the future. They don't want to get locked into a project and not get their money back. That's the simplest way of dealing with uncertainty, compute the payback. This is a slightly more sophisticated way of dealing with uncertainty. You can ask what-if questions. What if this, what if that? And I'll make a statement that's going to sound a little weird. It's become much too easy to ask what-if questions. You probably already noticed this in your project, what if this, what if that? Because in an Excel spreadsheet, it's easy to build in. I closed today's class with a story. I was actually, and I did my MBA between 1979 and 1981. So 1980 was the right midpoint for my MBA. Do you know what the world looked like in 1980? Paul Volcker had become chairman of the Fed. Inflation was 10%. And he was very clear, it's going to break the back of inflation by basically essentially pushing the company into a recession because that's the only way you can break inflation. So there was no job, there were no internship, nobody. So I got a job in the summer, which is an accomplishment to begin with a company called Watermark. It's really, you shouldn't call it a company, it's a small business. It produced radio shows, which it syndicated. In fact, it had only one show. And some of you, especially if you've driven across the US on a Sunday, have heard the show. It's called American Top 40. It's been around forever. It's a revolutionary idea. You know what the show is about, right? They take the top 40 songs for that week and they play them from number 40 down to number 1. You never start at number 1 and go to number 40 because you lose a lot of the audience. You got to keep the suspense going. And at that time, it was actually, the guy who did the show was a guy called Casey Kasem, legendary disc jockey. And he did the show, and it was actually a very profitable show. It sold to 524 stations every week. And each station paid $1,000 a week. So it's a pretty good business, $524,000. From that, they, of course, had to pay Kasem and all the rest of the staff. So they hired me that summer. And you know what they hired me to do? To analyze a second show called Soundtrack of the 60s. This was a super revolutionary idea. You know what they were going to do? Go back 20 years, which in 1980 meant going back to 1960, take the same week, and play the top 40 songs from that week. That must have taken a huge amount of creative thought. But they found a disc jockey called Murray the K, another famous disc jockey. And they hired me to assess the show. So my job is to compute. And I'd taken one corporate finance class. In my corporate finance class, every project already came with cash flows. You look at the end problem cash. So I walk into the company, and I remember the CFO didn't even have an office. He had a cubicle. I went up to the CFO and I said, you know what? I need some cash flows. He handed me a blank ledger sheet and he said, that's why we hired you. You got to do the cash flows. And he said, it's easy. You just have to figure out how many stations will buy the show and then multiply by what price we charge. Go talk to the marketing guy. Another cubicle, I walk over, and that guy hated my guts. I spent 3 days hanging outside his cubicle and he acted like I wasn't even there. He'd walk by me as if I was invisible. Finally, I decided that I have to stop him. I said, look, I've got to get started here. How many stations do you think would be interested in the show? He said, I don't know, 200, 300, 400, something like that. And he walks away. So I go back to my ledger sheet and I get it going. You know what I use as my base case? 200, 300, 400. I went right down the middle, 300 stations. And line by line, I built up that entire sheet. It took me 6 weeks of pulling teeth to get. I finally got done. I'm so proud of myself. I've got cash flows. I got a net present value. It's a negative number. I go to the CEO, who has a bigger cubicle, but still a cubicle. They said, look, I'm ready to present my results. And he said, let me call in the board of directors, which is 3 guys hanging around the coffee cooler. I don't know how they became the board of directors. They all sit around the table and I present the numbers and I hit them with that climactic finding. This show has a negative net present value. You should not do it. They look at each other and they say, you tried 300 stations, right? I said, yes. And they said, what would happen if you tried 400 stations? My stomach drops. Remember, this is an Excel spreadsheet. It's a ledger sheet where I worked out every number. You know what? Every number will have to get and I said, net present value will probably turn positive, but why would you want me to try 400 stations? He said, we've already decided to take the show. We just want you to tell us that we did the right thing. I said, you hired me, you paid me for 6 weeks to confirm a decision. I thought at that time it was because they were a small business, not very, you know what? This is more the rule than the exception. In most companies, people decide they want to take projects and then you're put in charge of grinding out the numbers to back somebody else. It's asked backwards. It's not the way it's supposed to be. It's supposed to do the analysis first, but it is the reality we face. But in those days, to ask a what-if question just took a lot of effort. So when we come back on Monday, we will talk more about some of the things we can do now that we could not do then. And it's a mixed blessing. Because there are things that people do that you look and say, where's the end game? Why are you doing this? You need to make a better decision. So let's end with that, and I will see you on Monday.
Thank you.
Take care.
Hey, Professor, I have a quick question that's kind
Sure.
of related. but it's for current events. Bill Gross said yesterday that he expects inflation to be 3 to 4% next year. Do you think that the Fed's going to have to reverse their decision and actually increase interest rates to get inflation under control?
What interest rate is the Fed even controls? If inflation goes to 3 to 4%, what do you think is going to happen to the T-bond rate?
It's going to go way up.
Think like a buyer of a bond.
Yeah.
If inflation is going to be 4%, would you buy a bond with a 2.5% rate? You wouldn't, right?
No. Yeah.
The Fed is, and this is the point, yesterday in CNBC, I kept getting asked, what do you think the Fed will? And I said, I really couldn't care less what Jerome Powell tells me he can or cannot do. Because if inflation comes back, there is nothing the Fed can do to change rates. The Fed doesn't set rates. I wish CNBC would kind of stop making that statement. The Fed sets rates. And yesterday there was some market strategy from some investment bank who fed into this. The Fed's going to raise rate. The Fed raises and lowers the Fed funds rate, which is a rate that none of us ever gets to encounter in our lifetimes. It doesn't set T-bill rates. It doesn't set T-bond rates. It doesn't set mortgage rates. All of those rates are driven by economic growth and inflation. So Bill Gross is right. You know what you should be doing, right? Selling your financial assets and heading for the hills.
Yeah.
The only caveat I would have, 3 to 4% inflation, there's almost no good scenario for any financial asset. Stocks are going to be damaged. Bonds are going to be damaged. Pretty much every financial asset.
So next year's going to be tough. Does that scare you at all?
If
or no?
Bill Gross is right. Bill Gross is not, Bill Gross is not the interest rate suits there either, right? So I'm not sure that I'm ready to jump off with Bill Gross off that cliff. But so if you believe Bill Gross, then I think you're going to be a lot more cautious about investing in financial assets. But he's been wrong a lot before.
Okay, thank you.